If you enjoyed this video, be sure to hit that sub button for more amazing content. Now, let's jump straight into the video. What's good, YouTube, and welcome back to the Bofino One podcast, and I am your host, Bofino One, and as you guys can see from the title of today's video, we're going to be talking about how the Federal Reserve just raised interest rates to the highest since 2007, and we're planning to possibly see higher rates in 2023, which is kind of scary. Well, I don't know if so much scary, but I mean, that's what they were talking about. They had mentioned that, the rates essentially would maybe people were speculating that rates would eventually start to drop in 2023, not go up. But it looks like there's a good chance they're going to be on the rise for at least, if not part of 2023, most of 2023. So before we get into this video, be sure to hit that thumbs up and subscribe, and let's jump straight into it. So the Federal Reserve raised short-term interest rates Wednesday by 0.5%, bringing benchmark interest rate to the highest level since 2007, while suggesting more rate hikes are coming in 2023. Wednesday move brings the Fed funds rate to a range of 4.25% to 4.5%, capping a year that saw the central bank raise rates by a collective 4.25%. Wednesday's 50 basis point rate hike did mark a slowdown from the Fed's recent pace of rate hikes, as the central bank had raised rates by 75 basis points at each of its past four policy meetings, its most aggressive stretch since the 1980s. In quotes, over the course of the year, we have taken forceful actions to tighten the stance of monetary policy, Fed Chair Jerome Powell said on Wednesday. We have covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. So, you kind of think about that. I mean, they're saying that they're going to raise the rates, right? They're raising them now, and we still have more work to do, meaning that there's a good chance that rates are going to keep going up because they're trying to stop inflation. They're trying to essentially stop the demand. And as many people would say, we are already kind of in a recession, and there's a good chance in 2023 it will be an official recession. They will officially announce it. But not financial advice, that's just my speculation. In its statement announcing Wednesday's move, the central bank included wording which said it anticipates ongoing increases in interest rates, implying the Fed does not intend to pause rate hikes imminently. In quotes, the committee anticipates that ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that it's sufficiently restrictive to return inflation to 2% over time, the Fed statement said. New economic forecasts from the Fed published Wednesday show officials now see benchmark interest rates peak at 5.1% in 2023. So this is kind of what I was saying. They're expecting it to peak, meaning that it's going to keep going up in 2023. And I know a lot of people were expecting for it to go down, for it to decrease, but that doesn't look like that's going to be the case. It looks like we're going to go down. So an extra 50 basis points higher than the previously projected 4.6 back in September. Officials then see rates coming down to 4.1% in 2024, slightly higher than previously projected. And this is kind of what I had mentioned, but this is what you kind of see a lot of people talk about, is that they're saying 2024 might be the year where things kind of go back to normal, I guess you could say. And at the same time, that's when you can expect to maybe start getting into homes and buying cars, etc., once a lot of stuff has cooled down. So these projections come after Fed Chair Jerome Powell said last meeting that rates will need to move higher than previous projections in September. 7 officials see rates rising higher than 5% next year, with 5 clustering around 5.25% and 2 seeing rates peaking as high as 5.6 next year. Officials don't see core inflation coming back down close to target until 2024, with inflation rounding out this year at 4.8%, below falling to 3.5% next year and 2.5% in 2024. So kind of like what I said, they're saying that, they're expecting 2024 2.5%. So things will kind of, I guess you could say, be more normal then. I don't know if that's the right term, but maybe things will have leveled out. We probably will be through the projected recession that, people are saying, and a lot of analysts and people are expecting. Officials see unemployment rising to 4.6% next year and remaining at that level through 2024. And so that's kind of the next thing, is we're seeing a lot of job layoffs. A lot of people, sad to say, first of the year are probably going to be laid off because there's going to be the bottom line. A lot of companies are going to look at their bottom line end of the year, and they're going to see that, hey, we're not hitting it, so we're going to have to cut people. So unemployment rates will rise. The Fed sees below average economic growth, with the economy barely growing next year at just 0.5% before picking up slightly to 1.6% in 2024. Asked during a press conference on Wednesday whether these forecasts with slowing growth and rising unemployment suggest the Fed would tolerate the economy tipping into recession, Powell said. I don't think it would qualify as a recession because you've got positive GDP growth. The Fed move comes as inflation has started to show signs of slowing the past 2 months after hitting a 40-year high this spring. The consumer price index, excluding the more volatile food and energy components, rose 0.2% month on month in November, down from 0.3% in October and 0.6% in September and August. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases, Powell said. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. And so that's the thing, is that, they're going to have to raise inflation more, I guess you could say, to kind of ease the demand, right? So, because you still have a lot of people out there that, they're not really feeling it. Certain people in certain, I guess you say, economic classes are not really feeling the pressure or the pain that a lot of people are feeling, meaning people that are probably in the upper middle class and, considered like upper middle class and probably rich. They're not really feeling this particular economic strain that so many other people are right now, right? And so with that being said, I feel like that's part of the reason why they're still trying to raise inflation, because there's still a lot of things that you can't get. Like, I just went to the car dealership today, and a lot of cars and certain things are still not out there. I mean, they literally told me that there was a car that I saw online that was in transit, or at least that was there or in transit. Someone already put a down payment on it so they could claim it, right? So there's still that group of people that is not really being affected. So I feel like they're also trying to raise inflation to kind of pause even the people that can't afford or that are in good financial situations, is to try to just stop demand as a whole, which essentially creates a recession. But yeah, let me know your guys' thoughts about this down below in the comment section. I do think this is an interesting article. That's why I wanted to get on here and share it with you guys. And yeah, if you enjoyed the video, hit a like, comment, share, and I'll catch you guys in the next one. Peace.